Good evening, everyone. I'm going to present a topic on capital asset pricing model by Fama and Kennison French. Fama just won the Nobel Prize because of the asset pricing model, and but it's not based on this article. It's another one on the market hypothesis. But anyway, this is another paper he did, and I'm going to present it. First of all, is an introduction of what we're going to cover in this topic. CAPM is a classic model of asset pricing theory. It established the relation between expected return and risk. But the problem with CAPM is the empirical results is poor. It's really poor. So let's go to the next slide. Logical CAPM, it is built on modern portfolio theory by Markowski, the efficient frontier. And based on CAPM, market portfolio should be efficient and only efficient frontier because of two assumptions. One is a complete agreement, which means market clearing asset price at t minus 1 and agree on the joint distribution of asset return from t minus 1 to t. So, and another assumption is investors can borrowing and lending at a risk-free rate. So this graph is showing CAPM. As we can see, the curve A, B, C is a modern portfolio theory. It is showing the efficient frontier. While point T is actually the market portfolio according to CAPM, while the intercept is the risk-free rate. As you can see, the best risk-return trade-off point is actually the line of risk-free rate and the market portfolio. And the straight line is the mean variance efficient frontier with risk-free assets, according to CAPM. So all efficient portfolio combination of the risk-free asset and market portfolio according to Taubin, this is called separation theorem, which means in the market only the combination of risk-free asset and market portfolio is efficient and optimal. The weight of market portfolio relative to risk-free rate depends on the risk tolerance of investors. Implication is and the implication is that the expected return of individual asset is equal to expected return of risk-free in CAPM plus beta times the risk premium of the market. The expected RZM, the first term, is any assets that are not correlated with the market. In CAPM, it refers to risk-free rate. And beta is the calculation of the covariance of individual asset to the market divided by the total average risk of the market. Sometimes beta is interpreted as how the movement of individual assets is sensitive, impacted by the move of market returns. Another way of looking at it is given the fact that the variance of market is the weighted average of the covariance individual assets within market. So we can say beta for asset I is actually measuring how the covariance of the individual asset together with the average market divided by the average market return. It's like relatively how risky this asset is compared with the market risk. Okay, let me redo this part. Another way of interpreting beta is that the variance of the market is the weighted covariance of assets underlying the market, and thus beta is how the covariance risk of asset I in the market relative to the average covariance risk of assets in the market. So this is another way to define beta, and people have done this. But for CAPM, you can see these assumptions are not realistic. In reality, we don't have risk-free borrowing and lending, regardless of the amount you borrow or lend. And also, the complete agreement assumes information is available to everyone, and every investors agree on the joint distribution of the future return. That's unrealistic. Regarding the risk-free borrowing and lending, Black campaign by Fisher Black in 1972 argues that even without risk-free borrowing, if there are unrestricted short sale risky assets, campaign still holds, but still it is not realistic. But as we know, all models are wrong, some are useful. That's why we can still test it using the data to see how useful are they. Early empirical test starts from risk premium, which is the beta times the market risk premium. In testing this, there are two problems. First of all, measurement errors is large when if using individual assets, and also the residual correlations from some common sources of variation not included here may bias estimation. So that's why some researchers started with solid beta portfolios in cross-section data to have improved the measurement error. Fama and Macbeth in 73 did month-to-month cross-section means with standard deviation to address correlation of the residual. Basically, what they did is they get a lot of beta and they get a lot of betas by do multiple months cross-section mean cross-sections and take the average of the mean and also the standard deviation to measure the true coefficient beta with this information. And it's sort of like a bootstrap strategy, in my opinion. If I'm not correct, if I'm wrong, just we can talk about this later after this. And also, Jason is the first one to use time series regression, and he's famous for Jason's alpha. Risk premium empirical tests findings are that relation between beta and average return is too flat in reality, and also intercept is larger than risk-free rate predicted by CAPM. So this is a graph by Fama and French in this article that using historical data and sorted sorted portfolios into different beta and compared the actual return versus the return predicted by CAPM, we can see that for low beta, the actual return is actually higher than the return predicted by CAPM. But for high beta portfolios, the actual return is actually smaller. So overall, the distribution is flatter. The regression line is flatter than CAPM. Another round of tests is on whether market beta explains expected return. In other words, whether there's any other variable that can explain the total return. So some people add extra explanatory variables in cross-section regression, and the non-hypothesis is for the new added variables, the slope, if coefficient equals to 0. For time series, there should not exist any portfolio that the intercept is reliably different from 0. But based on this finding, the bottom line is that the central predictions of black version of CAPM seems to hold. More recent empirical tests focus on the ratios and sizes such as EP ratio, small stocks versus large, debt equity ratio, and market book to market equity ratio, which is known as the growth value factor in later studies. But like why ratio matters? Fama in French argues that the return of asset does not only depend on expect cash flow, but it also depends on the discount expect cash flows. So in other words, stock price, which is an indicator of future cash flow, can include information not included in market itself. But the only problem with using price as a factor, as a variable, is that it is not scaled. So we need to scale it first. So that's why we have a lot of these ratios. Some French in 92 article talk talk it this way. Variables like size, earning divided by price, leverage, and book to market equities are all scaled versions of the firm's stock price. And some are redundant for explaining average returns. Even though there might be some findings on the CAPM, and some people believe empirical results of CAPM is serious, but the explanation of that is different. One group of researchers believe it's behavior related, it's irrational pricing. So investors over extrapolate past performance. So for stocks with high book to market value, these are the companies that have fallen too bad during bad times, and there might be overreaction from investors to this past performance. That's why they have a low book to market ratio. So that's why it can underperform. That's why it can overperform. Sorry, that's why it can outperform because the price is underpriced. Another group of researchers are looking for some more complicated asset pricing because they think some assumptions in CAPM, such as investors only care about mean and variance of one period portfolio return, is unrealistic, and they want to count to the fact that how portfolio returns co-vary with labor income and future investment opportunities. Some examples of the more complicated asset pricing model includes intertemporal capital asset pricing model by Metten in 73 and arbitrage pricing theory Ross in 76 and three-factor model by fama French. Let's focus on three-factor model since this is the fama French model and they talk about this in their paper. The main shortcoming is its empirical motivation, but it's not fatal. Because CAPM is a good framework to use, but it does not require the model to mimic relative state variables. And also, in the three-factor model, the portfolio itself is still multi-factor minimum variance, and portfolio itself is different from multi-portfolio because you have other factors included. But behavior says the value factor is still a result of investor overreaction. But some people argue that the behaviorists only assume the value factor is related to the assumption that price are rational. So which means the price can be irrational, but some other assumptions might be violated as well, and that's what value factor can be capturing. So in other words, model group researchers think behaviorists are not able to account for all these possible variations captured in the value factor. So it's limited basically. They don't believe in each other. So for now, there are some arguments of average return premiums of the three-factor model can come from rational results of underlying state variable risks, such as ICAPM, defining ICAPM. And also it can be results of irrational investor behavior as talked about by behaviorists. Also it can be just a sample specific results of chance, by chance alone. But regardless of what the two reasons are, even though it's unexplained, but the model itself can still be useful in application. They do point out that momenta, which is the effect that stocks do well, tend to continue to do well, while stocks that do poorly continue to do poorly. By Jacob-Deshi and Titman in '93 is an important factor to consider or include it to make a four-factor model. And also some proponents of CAPM said all these tests are meaningless because CAPM can never be tested. It will never be because in the market portfolio we don't know which assets can be legitimately be excluded, and also we have limitations on the data. However, they argue that this cannot be used to justify the way CAPM is currently applied. In other words, if you think CAPM is not testable with the proxy of market, why can still people use proxy of market and using CAPM in application? So in other words, it's not testable, you cannot use it. So this is exactly what they say. Cannot use the same market proxy in application if not working in test. And in test impact, another factor is the impact of price ratio is also a major problem that cannot be ignored. So the conclusion is that the sharp-Lintoney CAPM has never been empirical success, while the black version of CAPM has some success. But the main issue is that variable like size, various price ratios, and momentum are serious enough to invalidate most applications of CAPM. And when you use CAPM to do cost of equity capital, there are two issues here. First, typically only include US common stocks as a market proxy. And also the empirical relation between beta and average return is flatter than predicted by Sharp-Lintoney CAPM. In the industry of mutual funds, if you use CAPM to estimate the manager's performance, some passive managers can produce abnormal returns if they invest strategies involve like new value and small. They can still produce abnormal returns because of the empirical problem of CAPM. So this is not right? And for us, how to teach CAPM, it is still a good concept to teach as an introduction to the fundamental concepts, but we do need to warn students on empirical problems in application. So this concludes all the presentations, and do you have any questions? Please feel free to let me know. Thank you.